Mu has gained 600% in 12 months on a single thesis. AI demand for memory is structurally different from prior cycles, and the shortage is real. The 30-year Treasury yield breaking 5.18% on May 20th does not challenge whether that demand is real. It challenges what discount rate should be applied to revenue that arrives in 2028 and 2030. That distinction matters because MU's bull case is entirely built on forward earnings. The stock trades at 32 times trailing earnings, but under 8 times the forward multiple analysts project. The entire gap between those two numbers is a bet that the future revenue materializes as forecast, and long-end yields are the rate at which that future revenue gets discounted back to today's price. When the 30-year crosses 5.18%, the math of that discounting shifts against every stock whose value lives in future years, not in current cash flow. MU is precisely that stock. The mechanics arrived in sequence. On May 13th, the Treasury auctioned $25 billion of 30-year bonds at 5.046%, the first long bond auction above 5% since 2007, and the bid was described as subdued, meaning buyers demanded a concession to absorb the supply. 2 days later, CPI printed at 3.8% year-over-year, the highest since May 2023, and the producer price index rose 6%, the steepest pace since late 2022. Those two inflation prints converted the auction's weak demand from a one-session event into a durable yield signal. By May 20th, the 30-year had extended to 5.18%, and 22V Research noted that yields on long-dated debt across the US, Europe, and Japan had each moved above the 90th percentile of their historical week-on-week ranges, a simultaneous repricing across global duration that removed the usual hedging offset. The probability that the Fed raises rates by year-end moved from 20% to 60% in the CME Fed Watch tool within the same window. The new Fed chair, Kevin Warsh, who inherited what economists call the most divided Federal Open Market Committee in 30 years, has not responded, and that silence is itself a signal that the long end is now doing the Fed's tightening independently. Deutsche Bank's rate strategist noted that 5% on the 30-year could attract pension fund demand, but added that demand remains contingent on the Fed's inflation response. So far, pension reallocation has not materialized as a counterweight. What that means for MU is that the duration tax is rising without an offset already in the market. The condition that would stabilize MU's forward multiple requires either an inflation reversal or a Fed acknowledgement, and neither have arrived.
The yield move alone does not explain why MU leads the semiconductor sell-off, rather than trailing it. That explanation requires understanding the position structure behind the stock. BofA's May Global Fund Manager Survey, published the same Monday the 30-year was testing 5.18%, recorded the largest monthly jump in equity allocation in 24 years of survey history. Within that allocation surge, 73% of fund managers named long global semiconductors the single most crowded trade, a figure that had been 24% only 1 month earlier in April. That 49 percentage point jump in 1 month is the critical position pressure variable. It means institutional capital flooded into semiconductor exposure precisely as the bond market was building toward its yield break. The crowding created the overhang. The yield break released it. 22V research analyst Dennis Debouchery named the exposure ladder explicitly. Price momentum names, AI capex beneficiaries, semiconductors, and small caps, in that order of vulnerability. Memory sits at the intersection of all 4 categories, which is why 22V described memory as the highest conviction subtrade within the already crowded semiconductor trade. The result is a cascade structure. When the macro risk appetite drops, the first exits come from the most crowded names, which accelerates the price move in those names, which triggers additional exits from momentum-linked positions. MU, down 7.2% on May 19 alone before partially recovering, is inside that cascade. The position pressure that made the exit rational was not the yield level itself. It was the combination of an already fully loaded institutional stance and a yield that crossed the threshold where those institutions model increasing equity duration risk. At 3.9% cash levels, BofA's contrarian sell signal had already triggered. The fund managers were fully deployed with minimal dry powder to absorb the bond shock. What the position structure leaves unresolved is not whether institutions will reduce exposure. That process has begun. But whether the sell-side analyst community, which currently has 27 of 30 analysts covering MU at buy ratings, will follow with target revisions that acknowledge the discount rate shift, rather than simply maintaining price targets anchored to a pre-yield break earnings multiple.
The relative value divergence inside the memory sector deserves attention because it reframes the allocation question away from a binary hold or sell on MU. SNDK, SanDisk, gained 9% in a single session on May 22, while MU was still 17% below its 52-week high, and WDC, Western Digital, added 5% in the same session. The surface explanation is sector rotation after a punishing week for all three. The underlying structure is different. SNDK entered the bond yield week with 476% gains already in 2026, meaning its position pressure was asymmetric to the upside. Buyers who had missed the move were waiting for any pullback as a re-entry point. MU, at 600% gains over 12 months, but carrying a much larger market cap and a heavier institutional ownership concentration, did not have the same re-entry bid structure beneath it. When the sell-off hit, SNDK's relative scarcity, it is a smaller float with less institutional saturation, made the bounce proportionally sharper. The 9% versus 3% rebound ratio on May 22 is not evidence that SNDK has a stronger fundamental thesis than MU. It is evidence that SNDK carries less crowding risk in its cap structure. That distinction matters for positioning because the AI storage demand thesis that underpins all three names is structurally intact. WDC's Q3 2026 report showed revenue of $3.337 billion, with net income of $3.205 billion, alongside a 20% dividend increase, driven explicitly by AI infrastructure demand from hyperscale customers. Seagate CEO and WDC CEO both stated on recent earnings calls that AI-driven data growth is accelerating faster than investors anticipated. Citi doubled its price target on MU to $840. Mizuho sees strong NAND and DRAM pricing extending into 2027. The fundamental demand signal is not degrading, but the discount rate applied to that demand has risen, and MU's higher market cap with deeper institutional saturation means it absorbs more of the duration repricing per dollar of forward earnings than SNDK or WDC do. The relative value gap that opened this week is a direct function of crowding structure meeting a yield shock, and it has not closed even after May 22nd's rebound, because the 30-year yield has not retreated from 5.18%, and the institutional position imbalance in MU has not confirmed a net reduction.
The convergence point for all three preceding layers, the yield break, the crowding unwind, and the relative value divergence, was always going to be NVDA's earnings, reported on May 21st. The memory supercycle thesis is structurally dependent on AI infrastructure capex continuing to accelerate, and the market had established NVDA's result as the binding confirmation. A strong NVDA print with strong forward guidance would have demonstrated that the AI revenue stream arriving in 2028 and 2030 is large enough to justify the multiple, even at a 5.18% long-end discount rate. A weak print, or guidance that missed the high-end bar, would hand the bond market an additional argument. Not only is the discount rate higher, but the revenue being discounted is also smaller than the bull case projected. The 5.18% threshold introduced in the first chapter becomes the verification benchmark here, not because yield levels are inherently decisive, but because MU's forward multiple of under 8 times earnings was already embedding a specific revenue trajectory, and any revision to that trajectory compounds the discount rate impact multiplicatively. MU's addressable market for high-bandwidth memory is projected to grow from $35 billion in 2025 to $100 billion by 2028, according to management guidance. That tripling of the market is the underlying arithmetic that justifies the forward multiple. If NVDA's result confirms that hyperscaler AI capex is sustaining at a pace consistent with that tripling, the yield shock becomes a repricing event rather than a thesis-breaking event, and MU's 17% drawdown from its high is where long-term buyers with a 2027-2028 horizon can begin to establish exposure at a discount to the pre-yield break multiple. The recovery path runs through the 10-year yield retreating below 4.59% as the primary threshold. That is the level at which 22V's surveyed investors model demand destruction risks aiding, and it is the level where MU's duration discount would mechanically compress. The invalidation of the bull case does not require a single quarterly miss. It requires the bond market to sustain yields above 5% on the 30-year through a period in which NVDA guidance also signals a slowdown, because that combination would simultaneously raise the discount rate and lower the revenue being discounted, collapsing the forward multiple from both ends. That double compression has not occurred, but the 5.18% yield established this week means one of the two conditions is already active, and what resolves the thesis is whether AI infrastructure spending proves large enough to outrun a discount rate that is no longer at the market's convenience. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.